If you are incurring losses on your purchases of gold, it's not an assumption, but it's a fact that you have entered only recently. I would say from here onwards, a very conservative target in a year or year and a half from now would be rupees 85,000 per 10 grams in Indian markets for gold on a conservative basis.
Hello and welcome to Invest Smart, a show where we talk about all things related to your money, your savings, and your investments. I'm Avni Raja. After the budget announcement of the customs duty cut on gold prices in India have crashed. So, what's the outlook for gold and what should investors do at this point in time? To talk about all of this, joining me on the show is Vijay Bhambwani. Vijay, thank you so much for taking the time out and speaking to us. So, first off, before we get into the details of what investors should do, what is your own sense of this customs duty cut move aimed at sort of reducing the prices and increasing demand?
Hello, Avni, and thank you for having me on your show. It's always great to be on your show. Well, I am not in a position to second guess the reason why the import duty on bullion was reduced. I believe the powers that we know the reason better, but all I can say is that any reduction in prices of gold is always welcome for the serious investor.
Right. So it's been a significant correction. I mean, from the highs that we were seeing a few months ago to the sudden crash at this point in time. The big question right now that investors want to know, especially those who have been holding gold and now are incurring losses at this point in time, what's the advice for them?
Well, if you are incurring losses on your purchases of gold, I'm not, it's not an assumption, but it's a fact that you have entered only recently. Had you even entered a year or year and a half ago, you would be still enjoying plum profits. So even if you entered very recently and what you are seeing is a temporary notional loss, I don't think you should fret too much because, as I have said on your channel in my past interviews, that the United States government has a very standard playbook. Ahead of the US elections, which happened to be in November of this year, their standard operating procedure is A, strengthen the dollar, B, reduce oil prices so inflation comes down. And since inflation comes down, and as a corollary to that, gold prices are pushed lower. The reason why gold prices are pushed lower is because gold prices staying high is always a sign of stress in the economy. So when you push gold down, you're boosting equities. That gives you a feel-good factor. Post elections, it'll be back to bullishness in gold.
Right. Just on that point, Vijay, because like you said, traditionally gold prices have moved inversely to equity, but over the last some time, we've seen both of them more or less moving in tandem. Do you agree with this, and how do you view this?
I agree with what's happening, and being a 360-degree kind of an analytical trader myself, I would always seek the reason. Once you know the reason, the cause and effect theory tells you that you will also know how long a particular phenomena will last. Now, you see, starting from 9/11, the Western governments have started printing a lot of unbacked currency. We saw unprecedented currency printing in 2008 after the global financial crisis, but that pales in comparison to what happened after the COVID lockdowns. The kind of currency printing that the West has resorted to has not been seen in human history. Now, that money has to find solace somewhere, so equities are going up. But at the back of the mind, serious guys know that this is ultimately going to lead to inflation. Go out to a restaurant and see what your bill, your food bill is, compare it with 3 or 4 or 5 years ago, you know what I mean. So serious guys are buying equity because that's where momentum is, but at the same time, they know at some point in time, inflation is going to be a party pooper. So they're buying gold. So which is why your paper assets and hard assets are moving in lockstep, in conjunction with each other.
So, in terms of one's view while investing in gold? How does one approach that? Do you still hold that it should be as part of a diversification strategy and as a hedge against inflation and economic uncertainty?
Well, the last time I was on the show with Vikram, I advocated a 20% allocation of your assets to gold.
Right.
Given a big enough decline, say gold prices were to fall another 10% from the present value, which is being quoted as I speak to you today, I would say go for the jugular. Raise it by all means to even 25% of your allocation. And if you permit me, I will even share the reason with you.
Yes, absolutely, Vijay. 25% is a huge allocation. So, if you could elaborate on that.
Yeah. Well, economies and business cycles are repetitive in nature. So, if you see a man walking a puppy dog with a leash, you'll notice that sometimes the puppy dog is veering to the left, coming back to the right, crossing the center point. That's called mean reversion in financial asset markets. So many a times the markets are counter-cyclical. They revert back to the mean, go to pro-cyclical. Counter-cyclical means the economy is going here, prices are going here. They diverge. In starting from April 2020, after COVID lockdowns were imposed on the world, you're seeing factories were shut, people were locked at home, but stock markets were going up. That's counter cyclicality. We have seen almost 4.5 years of counter cyclicality. In 2024, 5 dozen countries are holding general elections, the biggest being USA in November this year. Economic data is massaged, promises of reforms are made, a lot of feel good factor and gravy covering on economic numbers is resorted to. In 2025, all that sheen, all that gravy, and that feel good factor will start wearing off. So, counter cyclicality will give way to pro cyclicality, which means your financial markets will start going in the same direction towards the economy. And where is the economy? Down. So your paper assets are going to likely not see the kind of rally that you're seeing now. It might even see a reversal. Then where do you go? You go to something that has been tried and tested for over 3,500 years by humanity, and that's God's own currency, gold. You're back to gold, and that's where I expect 2025. The serious investors are going to go back home to gold.
Right. But what kind of a returns expectation would you have as far as gold is concerned? Because if you compare it to, say, equity, then obviously the returns would be much less. But over the long term, with such a big allocation to gold, what should one really expect?
Well, I will readily admit that I'm second guessing. I have no mathematical formula to give you an assured, guaranteed return, which is not possible at all. So I'm throwing an arrow in the dark. I would say from here onwards, a very conservative target in a year or year and a half from now would be rupees 85,000 per 10 grams in Indian markets for gold on a conservative basis. And should things get a little more hostile or challenging, for example, China attacking Taiwan or a geopolitical issue happening in Gaza or any other part of the world, if things get out of hand, maybe even 95,000 rupees per 10 grams. Like I said, I'm second guessing here.
Yes, of course, of course. So essentially, what you're saying right now is people should use this correction, at least in India, to increase their allocation towards gold.
Yes, they should. And a word of caution here, please do not try to buy gold in leverage. If you're buying futures, see, I'm a very return sensitive investor. I'm 58 years old. Whatever I had mistakes I had to make in the markets, lose money, it's all done and passed behind me. Now, I know one thing. If I go out there and buy a 10-year sovereign benchmark bond, I'll get close to 7% yield per annum. If I buy gold or silver in futures, I will be paying 18 to 20% cost of carry, financing charges per annum. It doesn't make sense to get 7% on my capital and pay 20% on borrowed capital. So please go for deliveries. That way, your take home profits will be higher. You're not working for the money lender.
Right. In terms of the other avenues of investing in gold, sovereign gold bond investors at this point in time are very disappointed, obviously. But even other than that, whether it's the gold ETFs, and of course then you have physical gold. You've not been a big advocate of either ETFs or sovereign gold bonds, but if you can just outline for our viewers why that's your view and what are the pros of investing in physical gold versus the other two.
Oh, thank you very much, Avni, for asking this question because whenever I meet a lot of people, they Vijay, you're an old man. You are too conservative. There are electronic ways of owning gold. Why do you always stick to physical? So I love it when you ask for a reason. The reason is what it's all about. Sovereign gold bonds, I'm reading media reports. There is a possibility of the government not issuing a fresh series of these SGBs. So why get into something that may not be around? It's like saying I'm buying a car, the model of which might be phased out in 6, 8, 12 months. It doesn't make sense. Now for ETFs. ETFs are backed by physical gold, fair enough. It's like having gold in somebody else's vault and you owning the paper that says, hey, you own this, but I'm keeping it with me. Fair enough. I have no problem with that because these are certified known institutions. My problem is that I am made to pay the storage cost, which goes as expense ratio for any ETF. I pay for the fund manager's salary. I pay for no ETF is 100% invested in gold. There is a small amount of leeway left in cash so that the fund manager can always take positions in the futures market to hedge his trades. Now, hedging is never perfect. There will always be some trades that lose money. So if I was to hold physical gold absolutely in my own vault, my NAV of that gold will go in lockstep with the price of gold. But if I'm holding ETF, there are expenses, there are holding charges, the physical hold custodian charges, there are salaries of the fund, there are the enterprise expenses, electricity, telephone, tea, coffee bills of the fund that is running the show, plus the hedging losses that might occur. I don't want these leakages irrespective of how small they are. I'm very conservative. Like I said, I'm very return sensitive.
Right. So, in terms of physical gold, obviously there are other issues that come into play. People are wary about where they're buying it, how to check for purity. Any sort of advice on that?
It's a misnomer that it's difficult to buy and hold physical gold. That's a completely mistaken belief. I'm sure in whichever part of the country you're staying in, or whichever part of the world you're staying in, there has to be an equivalent of a Zaveri Bazaar. Zaveri Bazaar is a local regional place where you have a lot of goldsmiths, jewelers concentrated in that area. Now I'll talk about India in specific, and with a special focus on the four metro cities. If you're talking about four metro cities, the setup is almost 100% replicated elsewhere. Now you have a Zaveri Bazaar where there's a gold market. Around these gold smith shops, there are these freelancer gold purity verifying shops. All right. Now, number one, when you buy gold, it is compulsory for the gold to be hallmarked. It is stamped, it is hallmarked for the purity. And when you're buying, you're supposed to get a bill and a hallmark certificate. Now, do you think any goldsmith would risk penal action and lawsuits, consumer court cases, and even suspension of their gold licenses by cheating you on that gold? It's difficult, but possible. So you go to the next door guy who runs only a gold purity verifying shop. I'm not talking about the rub test. You rub that gold on a black stone. You're only checking the surface. The core could be something else. So you go to an electronic testing shop in Mumbai, in the Zaveri Bazaar area. Do you know how much they charge you per instrument of gold. It could be a 1 rupee, 1 kilo brick, or it could be a pair of earrings. Your standard fee is between 50 to 75 rupees per piece of gold.
Okay.
You are paying the cost of a roadside sandwich to get your gold verified. It can't get cheaper than that.
Right.
So don't be in a mistaken belief that buying physical gold is too expensive. It's not. Your price of gold in Zaveri Bazaar in the physical market could be anything between 125 rupees per 10 grams to 350 rupees per 10 grams higher than the MCX price. The price is very, very fine, provided you're going to a good wholesaler.
Right. And Vijay, another question on the tax treatment, especially now after the recent budget, because ETFs would be considered a listed security, so it would be taxed at the 12.5% rate, while physical gold would have a higher taxation, impact. How do you see that offsetting the benefits of physical gold?
Well, unfortunately, death and taxes have no remedies. So, this is one thing that we'll have to put up with. But since gold is something that I intend to hold on for a very, very long time, I'm not really sure whether the tax regime will stay at the present levels by the time it's time to get off the gold bus. Because the gold bus has a long journey ahead, a couple of years at least. Do remember counter cyclicality. When the economies are not doing great, but the financial asset markets are going up, counter cyclicality has been in play for 4.5 years. Pro cyclicality would start in 2005. So what if pro-cyclicality lasts for 3, 4, 5 years? That's a long, long time to go. Are we really going to worry about pennies to the dollar, which is say 12% or 15% LTCG? I don't think you should.
All right, Vijay, we'll leave it there. Thank you so much for
Thank
joining
you.
us.
Thank you for having me.